Welcome back, everybody, to another deep dive. Today we are taking a look at something that I think is on everyone's mind pretty much constantly these days,
Yeah.
and that's money.
Always on the mind. Always.
Whether you have a lot or a little,
Yeah.
always thinking about it.
But specifically, we are diving into How to Think About Money by Jonathan Clements, which has a fantastic foreword by William Bernstein.
Oh, yeah, great book.
Yeah, this is one that you guys sent in a while back, so I know you're probably thinking,
Original Finance 101.
yeah, like all the usual tips and tricks. But I gotta say, this one goes way deeper than that.
Much deeper.
And I think right out of the gate, it challenges a lot of the assumptions that I know I have had
Yeah, me too.
about wealth and happiness and all that good stuff.
It really gets into the psychology,
Yeah.
the behavioral psychology behind all of our money decisions.
Yeah, so let's jump right into that. I think a lot of people are probably wondering, does money actually buy happiness?
Right.
And I love that the book doesn't shy away from that. It's the big question everybody wants to know.
Yeah.
And they
Yeah.
actually lay out the data for us.
I mean, they go into it.
The cold, hard facts.
So I'm curious, what does the research say?
Well, it turns out
Drum roll, please.
that while, having enough money to cover your basic needs is super important for your well-being, obviously,
Obviously.
that, feeling safe and secure.
Right.
But beyond that,
Okay.
research shows that happiness levels tend to plateau after a certain point.
Really?
So after an income of about $75,000 a year.
75K.
Now, that figure might vary a little bit, depending on where you live and your own personal situation.
Makes sense.
But the big takeaway is that after you reach that level, having more money
Yeah.
doesn't equal more happiness.
Oh,
At least not automatically.
that's kind of mind-blowing, isn't it?
Yeah.
I feel like it goes against
Everything we're told.
everything. Our whole culture is like,
Spend. Spend. Spend.
yeah, more stuff equals more happiness.
Oh, it turns out that's not really true.
Not really true.
And the book uses this really great concept called the hedonic treadmill.
Ooh, I've heard of that.
You've heard of that?
Yeah. What is that again?
It's basically this idea that we humans are incredibly adaptable.
Okay.
So, we might get a raise or we might buy that bigger house that we've always wanted.
Right.
But pretty quickly that thrill fades.
Yeah.
We get used to it.
It's like the novelty wears off.
Exactly. And we end up right back where we started.
I get that.
Back at that baseline level of happiness, wanting more.
It's like we're running on a treadmill.
Yeah.
You're going and going, but you never get anywhere.
Constantly striving, never really getting ahead.
Oh, man, that is too real. I'm thinking of so many examples of this in my own life.
Yeah, we all do it right.
I mean, I remember when I finally bought my dream car.
Oh, tell me about it.
It was a vintage convertible, and I was
Classic.
ecstatic for about a week, and then it just became my normal car.
It's just a car.
Yeah. And then I started thinking, oh, I need a new sound system in here.
Yeah, you got to upgrade it.
Yeah, and maybe some leather seats, and you know how it goes.
That's the hedonic treadmill in action.
That's it.
It gets us every time.
Every time, I'm telling you. But, okay, the book also goes into this thing called the focusing illusion.
Yes.
I don't think I've heard of that one before.
So the focusing illusion is this idea that when we think about what would make us happier,
Okay.
we tend to overestimate how much certain things would actually matter in our day-to-day lives.
So we're not very good at predicting our own happiness?
Not really.
Yeah.
No.
Interesting.
So if we think about a higher income,
Okay, more money.
right, we tend to fixate on that one thing,
Yeah.
thinking that's the key to happiness.
Yeah, more money, more problems, right?
Right. But we forget about all the other things that contribute to our well-being.
Like what kind of things?
Our relationships,
Yeah.
our health,
Mm,
our sense of purpose.
yeah, it's not all about the Benjamins.
Exactly. Money's just one piece of the puzzle.
Yeah. So if money doesn't directly buy happiness, what are we supposed to focus on? I know the book had some specific recommendations about how to actually spend your money
Yeah, there are some good tips in there.
in a way that actually does maximize happiness.
Really maximize it.
I'm all ears.
So one of the big ones is prioritizing experiences,
For experiences.
especially those that you share with loved ones.
Oh, I like that.
So things like travel,
Yeah.
going to concerts,
Mm-hmm.
even just having a picnic in the park.
Simple stuff.
Yeah, they create lasting memories.
We do.
And they strengthen those relationships, which are really important for our happiness.
So it's not about the stuff. It's about the memories you make.
Exactly. You can't really put a price tag on that.
You can't.
It's funny, there's this anecdote in the book that always sticks with me.
Okay, what is it?
So the author got an email from a reader who said, "You never see an unhappy person on a jet ski."
Okay, so maybe jet skis are the key to happiness.
I mean, it's obviously a bit of an oversimplification,
Yeah.
but it really highlights that feeling of pure joy and freedom.
That rush you get from those experiences.
Exactly.
Makes sense. And I love that it's something that you can share with people too.
Yeah, those shared experiences are so valuable.
Okay, so beyond experiences, the book also talks about like the importance of doing work you love.
Absolutely.
Why is that so important for happiness?
Well, if you're spending 40+ hours a week doing something that just drains you,
Yeah,
even a big paycheck isn't going to make up for that feeling of unfulfillment.
it's true. You're going to be miserable.
Yeah, and I think the book really challenges us to think about whether our work is giving us a sense of purpose.
Purpose is important.
Yeah, and if not, what changes can we make to find that?
I love that. And, we'll definitely be talking more about that sense of purpose later on in this deep dive.
Yeah, it's a recurring theme.
It is, for sure. But before we jump into that, I want to stick with this idea of happiness.
Sure.
Because the book goes on to tackle a topic that I think a lot of people are kind of clinging to. This very specific idea of retirement
Ah, yes.
and how that plays into our happiness.
The dream.
Yeah, like we've all got this picture in our minds of working until we're 65
Mm-hmm.
and then just sailing off into the sunset for like decades of leisure.
Retirement bliss.
Exactly.
Oh.
But what does the book have to say about that?
Well, it challenges that traditional model.
It does.
It says with people living longer,
Yeah.
demographics changing,
Yeah.
that model's becoming unsustainable for a lot of people.
Unsustainable.
Yeah, we're living longer and healthier lives.
That's a good thing.
It is. But our finances need to reflect that new reality.
Okay, so you're telling me I can't just picture myself like chilling on a beach
Why?
for 30 years after 65?
Maybe not for 30 years.
You're crushing my dreams here.
I'm not trying to crush your dreams.
Okay, good.
I think it's more about recognizing that we might need to redefine what retirement looks like
Okay,
in this century.
so what are you thinking?
Well, it could involve still working part-time,
Part-time. Okay,
or maybe pursuing a passion project,
I like that.
or finding ways to stay engaged and active in our communities.
Staying active, yeah, that's important.
Yeah, and it also means that we need to start planning early
Early,
and making the most of those longer lifespans.
we're going to be around for a while.
It seems like it.
Yeah, okay, that makes sense. And speaking of planning early,
Mm-hmm.
one of the key messages of the book
Yeah.
is the power of compound interest.
It's like magic.
I know it's magical, but it only works if you start early.
You got to get the ball rolling.
Exactly.
Yeah.
So for those of us who maybe haven't started yet,
It's never too late.
is it too late?
No. You can still benefit from compound interest.
Okay, good to know.
Even small amounts saved consistently over time
Okay.
can grow significantly thanks to the power of compounding.
It's amazing how it works.
Yeah, and the book actually highlights a specific strategy
Really?
that a lot of people might not think about,
Okay.
which is delaying your Social Security benefits
Delaying them.
until age 70. 70.
Now, it might seem counterintuitive,
It does?
but you'll actually end up getting a larger monthly check
Oh,
for the rest of your life.
that's a pretty good deal.
It is. So it's definitely something to consider,
Something to think about.
especially if you're betting on a long life.
Right, which sounds like we all are.
Yeah, it seems like it.
So I'm curious, the book also mentions annuities
Mm-hmm.
and longevity insurance.
Yes.
And I feel like those aren't always talked about in the whole personal finance realm.
Yeah, they can be a little bit more complex.
Complex, yeah. Are they something that the average person should be looking into?
Well, they can be valuable tools
Oh,
for managing the risk of outliving your savings.
that is a risk.
It is, especially with people living longer these days.
Makes sense.
So annuities can provide you with a guaranteed stream of income.
Okay, steady income.
Yeah, and longevity insurance is kind of like an insurance policy against living a really long life.
So if you live longer than expected, you're covered.
Exactly. It can help protect you. I like that.
From running out of money in your later years.
Okay. I'm definitely going to have to read more about those in the book.
Yeah, there's a lot of good info in there.
But okay, let's move on to something else that really caught my attention in how to think about money,
Okay.
which is this whole idea of rewiring our brains
Yes.
for financial success.
It's like we're battling our own instincts.
I know. When it comes to money, it's so true.
Our brains are wired for that instant gratification.
Oh, yeah. Well, we want it now.
And that can really get us into trouble.
Big time. But I love that the book actually lists like 22
22.
common mental mistakes that we make with money.
They're so relatable, it's almost embarrassing.
I know. I was reading through the list and I was like, oh my gosh, I do that one.
Me too.
And that one
They get us every time.
every time. So I'm curious which ones really stood out to you.
Well, one that I think a lot of people can relate to is the endowment effect.
Endowment effect.
Have you heard of that one?
That sounds familiar.
Basically, it's this idea that we tend to overvalue the things that we already own.
Oh yeah, we get attached.
We get so attached to our stuff, even if it's not really serving us anymore.
Yeah, like holding on to that old car or those clothes that you never wear anymore.
Exactly. We think, oh, but I paid so much for it.
Sentimental value.
Or it might come back in style.
Yeah, but it never does.
Right. But really, we're just holding on to clutter.
Makes sense. What else?
Well, there's also framing bias.
Framing bias. Tell me about that.
So that's the idea that the way information is presented to us can really influence our choices.
Like how it's worded or...
Yeah, exactly. Even if the underlying facts are the same.
Give me an example.
Okay, so imagine you see a sweater.
Okay, I love sweaters.
And it's originally $80, but it's 50% off.
Oh, that's a good deal.
Right. It seems like a steal.
I gotta get it.
But what if you saw the same sweater
Okay.
at a different store for $40?
Yeah.
Would you be as excited about it?
Maybe not.
Probably not.
But it's the same price.
It is. But the way it's framed
Yeah.
makes all the difference.
That is so sneaky.
It is. Marketers are very good at this.
They are good at what they do.
So the book encourages us to be more aware of these biases.
Okay.
And to make decisions based on the actual facts.
Not the hype.
Exactly.
Okay, so those are just a couple of the mental mistakes
Couple of the 22.
that we make with money. And I love that the book doesn't just point out the problems.
Right.
It also gives us solutions.
Lots of solutions.
So what are some of the ways that we can actually overcome these like impulsive tendencies?
Well, one of the big ones is creating a budget.
The dreaded budget.
I know a lot of people hear budget and they just...
They cringe.
Yeah, but it doesn't have to be scary.
Okay, good.
It's really just about being more mindful of your spending.
Knowing where your money is going.
Exactly.
Makes sense. What else?
The book also talks about automating your savings.
Automating.
Yeah, so you can set it up so that a certain amount of money gets transferred from your checking account to your savings account every month.
So you don't even have to think about it.
You don't even see it.
I like that.
It's like paying yourself first
That's a good way to put it.
before you even have a chance to spend it.
Smart.
And then another one that I think is really helpful is implementing a cooling off period.
Cooling off.
Yeah, so before you make a major purchase.
Like what's major?
Well, it depends on your situation, but let's say anything over $100.
Okay.
You do yourself 24 hours or even a week
To think about it.
to really sleep on it
I like that.
and make sure it's something that you truly want and need.
Not just an impulse buy.
Exactly.
So it's about putting systems in place that help us make better decisions.
Yeah. Give yourself those guardrails.
Those guardrails. Yeah, I like that.
It's like having those bumpers at the bowling alley.
So you don't end up in the gutter.
Exactly.
Okay, but let's move on to something else that I think a lot of people probably struggle with,
Okay.
and that's overconfidence.
Oh, yeah, the classic overconfidence bias.
We all think we can beat the market.
We all think we're the next Warren Buffett.
Exactly.
Ugh.
But the data shows otherwise.
It really does.
So why are we so bad at predicting the market?
Well, there's so many factors at play.
Right.
And it's impossible to know everything that's going on.
Yeah.
Even professional investors struggle to consistently pick winning stocks.
I think it's hard to admit that we're not
Yeah.
smarter than everyone else.
We all want to believe we have that special insight.
Yeah, but the reality is,
Most of us would be better off
yeah,
embracing a little humility
Okay.
and sticking with a simple low-cost investing strategy.
low cost, that's key.
It is, you don't want those fees eating into your returns.
Absolutely not. Okay, so speaking of simple,
Yeah.
the book introduces this really interesting idea
Oh, yeah, this one's a good one.
of using your paycheck as a financial compass.
Love that analogy.
I gotta say, when I first read that, I was like, what? How is
Yeah.
my paycheck a compass?
It's not intuitive.
Not at all. Help me understand.
Okay, so think of it this way.
Okay.
Your paycheck, your ability to earn an income,
Right.
that's your most valuable asset.
More valuable than like my house or my car.
Arguably, yes.
Interesting.
And the book calls this human capital.
Human capital. Got
And it basically says we should view it like a bond.
a bond.
Yeah, a bond that provides a steady stream of income.
Okay, so I'm getting paid like clockwork.
Yes.
How does that tell me like how to invest my money?
Well, it's not so much about telling you what to invest in.
Okay.
It's more about recognizing that your human capital,
Okay.
that steady paycheck, it's a huge part of your overall financial picture.
Okay. I'm starting to see it.
So when you're younger, you've got decades of paychecks ahead of you. So
Okay.
knock on wood.
Yeah.
That human capital is like having a huge bond holding.
Okay.
It gives you a lot of stability.
So I can take more risks with the rest of my money.
Exactly. You can afford to be more aggressive in your investment portfolio.
Because even if the market tanks, I
Yeah.
still got my income coming in.
You're not forced to sell at a loss.
Oh, that's a good point.
Mm.
Yeah, because like if you're retired and you're relying on your investments
Yeah.
and the market goes down, then you're kind of stuck.
You might have to sell at a bad time.
Yeah, that makes a lot of sense.
So this human capital framework can really help you make smarter decisions.
Smarter decisions about investing. Yeah, I'm definitely going to have to think more about that.
Yeah. It's a game changer.
It is, for sure, but I know we're just scratching the surface
Oh,
here.
yeah. We've got a lot more to cover.
We've got a lot more to uncover in how to think about money.
Definitely.
So stay tuned for part 2,
Yes. More insights to come.
where we'll delve into some even more counterintuitive strategies
They're good ones.
for building wealth and living a richer life.
Can't wait.
Welcome back to the Deep Dive. You know, as we're going through how to think about money, it really struck me how often we talk about personal finance
Right.
as if it's just like this isolated thing.
In a vacuum.
Yeah. But the book really emphasizes how much our financial lives
Yeah.
are intertwined with our relationships,
Absolutely.
especially within our family.
It's huge.
Yeah. So I'm curious, like, what does the book have to say about how our upbringing shapes our financial habits?
Well, it talks a lot about how our parents influence us,
Yeah.
both the good and the bad.
Both sides.
It argues that one of the most valuable things we pass on to our kids
Okay.
isn't actually money.
Not the money itself.
No, it's their financial habits.
Oh, so like the way we handle money rubs off on them.
Exactly. It's like financial osmosis.
Financial osmosis. I love that.
We absorb so much
Just by watching.
by watching our parents, whether we realize it or not.
Yeah. I mean, I can still hear my mom's voice
Oh, yeah.
every time I'm about to like buy something.
What does she say?
She's like, do you really need that?
The classic mom line.
I know. This is so true.
It is. And, you know, if we grow up seeing our parents struggle with debt
Mm-hmm.
or making impulse purchases, we're more likely to repeat those patterns.
Yeah. It's learned behavior.
It is. But on the flip side,
Okay.
if we witness responsible financial behavior,
Yeah.
you know, seeing them save diligently,
Mm.
making thoughtful spending choices,
Right.
those habits are more likely to stick with us.
So it's not just about lecturing our kids about money.
Right.
It's about showing them,
Yeah. Leading by example.
modeling that behavior.
Actions speak louder than words.
Yeah, for sure.
Right.
But I'm also curious, you know, the book mentions family can be like a double-edged sword
Oh, yeah, definitely.
when it comes to finances. So I'm wondering, how do we strike that balance
It's tricky.
between like supporting our loved ones
Hmm.
and protecting our own financial well-being?
It's a tough one on the one hand.
Yeah.
A strong family network can be a huge asset.
How so?
It can provide a safety net.
Oh, yeah.
Knowing you have people to rely on in tough times
Yeah.
can give you more confidence
Right.
to take risks.
What kind of risks?
Maybe start a business.
Oh, yeah.
Or pursue a career change,
Interesting.
knowing that your family has your back.
Yeah, it's like having a built-in insurance policy.
Yeah, like a cushion to fall back on.
I like that. But then on the other hand,
Here's the other side.
yeah, what happens if our family members get into financial trouble?
That's tough because we might feel obligated
Yeah,
to help them out, even if
Uh-huh.
it puts a strain on our own finances.
that's a spot to be in.
It is, and that's why the book really emphasizes
Yeah.
open communication about money within families.
Mm-hmm.
Having those sometimes difficult conversations
Yeah, those are hard.
can really help to prevent resentment down the line
Mm-hmm.
and protect everyone's financial health.
It's about setting those boundaries early on.
Yeah, being upfront about what you can and cannot do.
That's a good point.
Mm.
And, you know, I think it's also important to remember that helping doesn't always have to be about, like, handing over cash.
Right.
Sometimes it's about offering guidance
Mm.
or resources
Yeah.
or even just listening and being supportive.
Emotional support, that's huge.
Yeah, exactly. So it's about finding ways to be there for your loved ones.
Yeah.
Without jeopardizing your own financial stability.
Absolutely finding that balance.
Yeah. And, you know, speaking of setting our families up for success,
Mm-hmm.
the book talks a lot about the importance of teaching our kids
Yes.
to delay gratification.
That's a big one.
It is, especially in today's world.
Oh, yeah. Instant everything.
Everything right at your fingertips.
Yeah. How do you resist?
It's so hard, but it's such an important skill.
It is, and it applies to so much more than just money.
Oh, yeah.
It's about teaching them to think long term,
Mm.
weigh the pros and cons,
Yeah,
understand that sometimes waiting for what you want,
it pays off.
it's worth it.
It's so true. And, I remember reading in the book that people who have kids tend to retire later,
Makes sense.
which makes sense. Kids are expensive.
They are.
But I thought it was interesting that the book is actually dedicated to the author's 4 children, which kind of highlights this point.
It's a reality check for parents.
It is.
Yeah, those costs of raising kids, education, extracurricular activities.
How that stuff adds up.
It adds up, and it often coincides with our
Yeah.
peak earning years,
Oh, that's a good point.
making it harder to save for retirement.
So it's about planning ahead
Exactly.
Yeah.
Recognizing the financial implications.
and adjusting accordingly.
Right, being prepared.
Okay, so I want to circle back to that idea of using our paycheck as a financial compass,
Yeah, let's dig into that.
because I think we kind of left off
We did.
on that note. So can you remind me again?
Sure.
How does that work?
Okay, so remember your paycheck,
Mm-hmm.
your ability to earn an income.
Okay.
That's like a bond.
Like a bond. Okay.
It provides a relatively predictable
Okay.
stream of income.
Steady income.
Yeah, over your working years.
Got it.
So investing should
Yeah.
complement that income stream.
Not compete with it.
Exactly. It's all about working together.
Okay. So if my human capital is like a bond, how does that inform like how I should invest the rest of my money?
Well, it influences your asset allocation,
Asset allocation. Okay.
which is the mix of stocks and bonds in your portfolio.
So how much I put in each one.
Exactly.
Um,
And when you're young,
Okay.
you've got decades of paychecks ahead of you.
Knock on wood.
Fingers crossed.
Yeah.
Your human capital is like this huge bond holding.
So that means I could be riskier with the rest of my investments.
Exactly. You can afford to be more aggressive with stocks,
Stocks. Okay.
seeking higher returns.
Because even if the market takes a hit,
Yeah,
I've still got that steady income coming in.
exactly. You're not forced to sell at a loss.
I'm starting to see the bigger picture here.
Yeah, it all connects.
So as I get closer to retirement, though,
Mm-hmm.
that human capital bond starts to mature.
Right. Your earning years are winding down.
So that means I should probably shift more of my investments into bonds,
Yeah, to provide more stability and income.
especially once that paycheck disappears.
Exactly. It's all about preparing for that transition.
It's a gradual shift then,
It is.
from like growth to preservation.
Yeah, from growth-oriented to more conservative.
Okay, that makes a lot of sense. And this whole human capital lens
Yeah,
can also help us think about debt in a new way.
it really can. The book actually encourages us to view debt as negative bond.
Negative bonds.
Yeah, I know it sounds strange.
How did that work?
Well, think about it.
Okay.
When you buy a bond, you're lending money
Okay.
to a company or a government
Right.
in exchange for interest payments.
They pay me interest.
Exactly. But when you take on debt,
Okay.
the roles are reversed.
So I'm the one paying interest.
You're borrowing the money
Yeah.
and you're paying interest to the lender.
And that interest rate is probably a lot higher than what I could earn on a bond.
Most likely, yes.
Okay, so it's like I'm losing money
In a sense, yes.
instead of earning it.
Yeah, it's like having a negative return.
Negative return, yikes.
That's why the book says it often makes more sense. And okay.
To pay down high interest debt as quickly as possible.
Like credit cards.
Yeah, credit cards are notorious for high interest rates,
So pay those off first.
even if it means delaying other financial goals.
Interesting.
It's like stopping the bleeding
Yeah.
before you can start rebuilding your savings.
Makes sense. And the book also makes a pretty strong argument
Mm-hmm.
for paying off your mortgage before retirement.
It's a big one.
It is, why is that so important?
Well, it can significantly lower your cost of living in retirement
Okay.
and reduce that financial stress.
Yeah. No more mortgage payments.
Which can be huge.
Yeah. I mean, even if you have a decent nest egg,
Right.
those monthly mortgage payments can really eat into your retirement income.
They can. And one of the goals of financial planning
Yeah.
is to reach a point
Mm-hmm.
where money is no longer a source of constant worry.
That's the dream.
It is. And paying off your mortgage can be a huge step.
Towards achieving that peace of mind.
It can give you so much freedom and flexibility.
Yeah.
Freedom and flexibility. Yeah, that's what we all want.
Exactly.
Okay, so we've talked a lot about the positive aspects of financial planning,
Mm-hmm.
but I think it's also important to acknowledge the risks
Oh, yes.
that we face as investors.
Definitely.
So what are some of the big ones that the book highlights?
Well, there are three main ones.
Okay, hit me.
First, there's the risk of poor market performance.
Okay, the market can be unpredictable.
Yeah, we can't control it,
Right.
but we do need to be prepared for it.
Makes sense.
Then there's the risk of underperforming the market
Underperforming. Okay.
because of bad investment choices.
So picking the wrong stocks or?
Yeah, basically.
Ah.
And then finally, there's the risk of compounding those bad choices
Oh, no.
by trading at the wrong time.
Like panicking and selling when the market goes down.
Exactly. That's a classic mistake.
So how do we avoid these pitfalls?
Well, the book argues that
Right.
while we can't control the market's short-term movements,
Right.
we can control our reactions and our investment choices.
So it's about minimizing the risks that are within our control.
Exactly.
So step one is accepting that we can't predict the market.
Accepting that uncertainty.
Yeah, no matter how much we want to.
Right.
How many crystal balls we consult.
Yeah, those crystal balls are not reliable.
They are not.
Yeah.
But once we kind of embrace that reality,
Yeah.
it becomes pretty clear that trying to time the market is
Yeah.
not going to work out well.
It's a fool's errand.
You're more likely to lose money than make money.
Most likely, yes.
So the book advocates for this long-term buy and hold approach,
Yeah, that's a classic.
focusing on building a diversified portfolio
Absolutely.
that aligns with your risk tolerance and goals.
And your time horizon.
So instead of chasing hot stocks and trying to outsmart everyone else,
Yeah. That's a recipe for disaster.
it is.
It's about creating a solid foundation
Yeah.
and letting your investments grow over time.
Slow and steady wins the race.
That's the idea.
Okay, and that brings us to the risk of underperforming due to those poor investment choices.
Yeah, we all make mistakes.
We do.
But the book makes a really strong case for index funds.
Index funds, we've talked about those before.
We have.
But I think it's worth diving a little deeper.
Yeah, for sure.
So remind me again what makes them so special.
Okay, so index funds are basically baskets of stocks or bonds
Okay.
that track a specific market index,
Like what's an example?
like the S&P 500.
Oh, yeah, I've heard of that one.
Yeah, that's a popular one.
So you're basically buying a tiny piece of all those companies.
Exactly. And that gives you instant diversification.
Diversification, that's key.
It is because it spreads out your risk.
Right, so you're not putting all your eggs in one basket.
Exactly. And another great thing about index funds is that they're low cost.
Low cost, I like that.
You don't want to be paying those high fees.
Yeah, those fees can really eat into your returns.
They can, and with index funds, you're essentially capturing the market's return
Okay.
minus those small fees.
So it's like a set it and forget it approach.
Kind of, yes.
I like that.
But it's important to remember that index fund investing isn't totally passive.
Okay.
You still need to choose the right funds,
Okay.
rebalance your portfolio periodically,
Got it.
and stay disciplined with your contributions.
So there's still some work involved.
Yeah, but it's much simpler than trying to pick individual stocks.
Definitely.
And, index funds are particularly well suited for investors
Okay.
who recognize that beating the market consistently
Yeah.
is really, really difficult.
Like basically impossible.
Pretty much, yeah.
So it's about accepting that reality
Accepting the market's return as your own.
instead of trying to be a hero.
Exactly. It's about humility
Okay. Humility
and discipline.
and discipline. And speaking of discipline,
Yeah.
the book also talks about the emotional biases
Oh, yeah.
that can trip us up as investors.
Those pesky emotions.
I know. I've definitely made some impulsive investment decisions
Oh, we all have.
in the past that I totally regret now.
Yeah. Fear and greed.
Yeah.
They can really cloud our judgment.
Oh, they can big time.
So the book offers some strategies
Okay.
for overcoming these biases.
I'm all ears.
It encourages us to focus on the long term.
Long term. Yeah.
Tune out the noise of the market.
Ignore all the headlines.
Exactly. And remember
Yeah.
that stocks have fundamental value.
So even when the market is freaking out,
Right.
the actual businesses might still be doing fine.
You might be doing great.
It's hard to remember that, though.
It is, especially when you're seeing your portfolio drop.
But it's important.
It is, because those price fluctuations
Mm.
often don't reflect the true value.
Of the companies.
Exactly.
Oh, this reminds me of that analogy
Oh, yeah.
of the manic depressive
Mr. Market.
Mr. Market. I love that analogy.
It's so vivid.
It is, so Mr. Market represents the stock market,
Right.
and he shows up at our door every day,
Every single day.
ready to buy or sell our shares.
At a price that reflects his mood.
And his mood is all over the place.
Sometimes he's euphoric.
Yeah,
Sometimes he's depressed.
like a roller coaster.
But the point is,
Yeah.
his emotions shouldn't dictate our decisions.
We don't have to play his game.
We can choose to be rational.
Step back and breathe.
Exactly. Make decisions based on our long-term goals.
Not Mr. Market's mood swings.
Exactly.
Okay, so how do we actually do that?
Well, the book gives us some really helpful tools.
Give me the tools.
It encourages us to think like shoppers.
Shoppers.
Yeah, so when the market goes down,
Okay.
we can view it as a sale.
A sale?
It's an opportunity
Oh, I like that.
to buy quality assets at a discount.
Like those 50% off sales
Exactly.
at my favorite store.
You got to stock up.
I got to stock up when the market's on sale.
Exactly. It's a powerful reframe.
It is.
And the book also emphasizes the importance
Yeah.
of understanding a company's fundamentals.
Fundamentals, like
So
what?
especially their earnings and dividends.
Earnings and dividends, okay.
Those are key indicators.
Of a company's health
Exactly. It's about looking beyond the stock price.
and understanding the actual business.
Right, because a stock price can fluctuate wildly.
It can, for sure.
But a company's earnings
Yeah.
tend to be more stable over time.
More reliable.
Yeah, so it's about focusing on those long-term factors.
Long term, okay.
We're making informed decisions.
Informed decisions. I like that.
Not emotional ones.
No emotions.
No, we got to keep those in check.
Yeah, but Mr. Market might be emotional,
He might be.
but we don't have to be.
Exactly.
Okay, so, it's almost time to wrap up this part of the deep dive.
Already.
Yeah, I know time flies when you're having fun.
It does.
But before we do, I want to touch on this concept of earnings yield.
Oh, yeah, earnings yield.
I'm not sure I'm familiar with that term.
Okay, so earnings yield is basically
Yeah, break it down for me.
the inverse of the price to earnings ratio.
Inverse, okay.
So the PE ratio
Yeah.
tells you how much investors are willing to pay
Okay.
for each dollar of a company's earnings.
Earnings, okay.
So the earnings yield,
Just flips that around
okay,
and tells you how much a company is earning.
relative to its stock price.
Exactly.
Okay, so instead of just looking at the stock price,
Right.
we should also be looking at how much profit
Yeah, what are they actually making?
the company is actually generating.
It's a different perspective.
It is, for sure.
Yeah.
And why is that an important metric?
Well, the book argues
Yeah.
that it can be a more useful way
Than the PE ratio.
to evaluate a company's value.
Okay, so it's about focusing on the fundamentals,
Exactly.
looking beyond those surface level numbers.
Yeah, and really understanding the business.
Makes sense.
It's about making informed decisions
Informed decisions. I like that.
based on the facts.
Not the hype.
Exactly.
And we are back for the final part of our deep dive into how to think about money.
The grand finale.
It is. And I feel like we've already covered so much ground.
So many insights.
But this book is just packed with wisdom, so I know there's still more to uncover.
Oh, yeah, definitely. What are some of the key takeaways that have really stuck with you?
Well, one of the biggest ones for me is this idea that financial success isn't just about, accumulating wealth.
Oh,
It's about aligning your spending with your values.
spending with your values.
Yeah.
I like that. So it's not just about having a big bank account.
Right. It's about making sure your money is working for you
Working for you.
in a way that supports the life you want to live.
The life you want to live. Yeah. That makes a lot of sense. And, we talked about this earlier, this idea of the hedonic treadmill.
Oh, yeah.
We're all chasing these material possessions.
Thinking they'll make us happy.
Right.
But it turns out that happiness is often fleeting.
Yeah, the novelty wears off.
Exactly. And then we're on to the next thing.
Always wanting more.
It's a never-ending cycle.
It is. And so the book really makes this argument for focusing on experiences,
Yeah.
relationships,
Mm-hmm.
and finding work that gives you a sense of purpose.
Those are the things that really matter.
They do. I mean, at the end of the day,
Yeah.
those are the things that bring true fulfillment.
And those are the things that money can't really buy.
You can't buy happiness,
Not directly.
but you can buy experiences.
Yeah, you can create memories.
Memories, yeah.
Yeah.
And, the book talks about how a lot of people get caught up in this idea of keeping up with the Joneses.
Oh, yeah, the comparison game.
It's so easy to fall into that trap.
It is, especially with social media.
Oh, yeah, you're constantly bombarded with images of
Perfect lives.
perfect lives, yeah. And it makes you feel like you're not enough.
Not good enough, not rich enough.
Exactly. But this book really encourages us to look inward, to find success on our own terms.
What does success mean to you?
Yeah, not what society tells us it should mean.
It's a powerful shift in perspective.
It is for sure. And, speaking of perspective,
Yeah.
the book also stresses the importance of viewing our finances holistically.
Holistically.
So looking at the big picture,
Yeah, not just focusing on individual pieces.
but how it all fits together.
Exactly. And one of the key concepts here
Okay.
is using your income or your human capital
Human capital, yeah.
as a central organizing principle.
Okay, so remind me again, how does that work?
So your human capital
Yeah.
It's basically your ability to earn an income.
Okay.
It's your most valuable asset.
More valuable than like my house or my car.
Arguably, yes.
Oh, okay.
And so the book says we should make financial decisions
Okay.
that support and protect that income stream.
So like investing in my education.
Yeah, investing in your skills.
Building my network.
Absolutely.
Making sure I have the right insurance in place.
All of that is part of managing your human capital.
Makes sense.
It's like treating your career as a long-term investment.
A long-term investment. I like that.
Or investing in yourself.
Okay, so then how does this human capital framework actually like guide our investment decisions?
Well, remember when you're younger,
Yeah.
you have more time to recover from financial setbacks,
So
so you can afford to take more risks.
okay, more risk when you're younger.
Exactly. You can be more aggressive in your portfolio.
Aggressive, okay.
Because even if the market takes a dip,
Yeah.
you still have time to make up for those losses.
And I've got that steady income coming in.
Exactly. You're not forced to sell at a low point,
That's a good point.
but as you get closer to retirement,
Okay.
that human capital bond starts to mature.
It does, yeah.
So you need to shift your focus.
To be more conservative.
Yeah, to preserving your capital and generating income.
Okay, so it's all about like adjusting your strategy
Yeah,
as your circumstances change.
exactly. It's a dynamic process.
Okay. And, we've talked about maximizing our income.
Mm-hmm.
But the book also spends a lot of time on this idea of minimizing our losses.
Winning by not losing.
Yeah, I love that concept. So how do we actually do that?
Well, it starts with recognizing the things that can drain our wealth.
Okay, the financial leaks.
Yeah, those pesky leaks. So things like high investment costs,
Okay, those fees can add up.
they really can.
What else?
Emotional trading.
Oh, yeah, letting our emotions get the best of us.
Exactly. And then also falling prey to those clever marketing
Oh,
tactics.
yeah, those are everywhere.
They are.
Designed to make us spend money.
Exactly. So the book gives us strategies for plugging those leaks.
Okay, give me the strategies.
Well, when it comes to investing,
Yeah,
the book is a big proponent of low-cost index funds.
index funds, we've talked about those.
We have.
They're kind of a recurring theme.
They are, for good reason.
So remind me again, why are they so great?
Okay, well, they offer broad diversification.
Okay, spread out the risk.
Yeah. And they eliminate the need to pick individual stocks
Okay,
or try to time the market.
which most of us are not very good at.
Let's be honest, no.
No. So it's about keeping it simple.
Exactly. And letting the market do its thing.
And then when it comes to managing our emotions,
Those pesky emotions.
the book reminds us that market downturns are going to happen,
They are inevitable.
but there are also opportunities.
Opportunities, okay.
Yeah, to buy quality assets at a discount.
It's like a giant sale.
Giant sale. I like that.
So instead of panicking when the market drops, you
Right.
can view it as a chance to stock up on your favorite investments.
Okay, so change your perspective.
Exactly. Reframe your thinking.
And then what about those impulse purchases?
Well, the book has some good tips for that, too.
Okay, tell me.
Things like creating a budget.
The dreaded budget.
It doesn't have to be scary.
Okay, good.
And automating your savings.
So you don't even have to think about it.
Exactly. It just happens automatically.
I like that. And also implementing a cooling off period.
Oh, yeah. The cooling off period is key.
So before I buy something,
Anything over a certain amount,
okay,
you give yourself some time
to think about it.
to really sleep on it.
Make sure I actually want it.
Exactly.
Yeah.
And that it aligns with your goals.
Okay, so it's all about putting these systems in place.
Yeah, those guardrails.
Guardrails that help us make rational decisions.
Even when our emotions are running high,
It's so easy to get caught up in the moment.
it is, but these strategies can really help us stay on track.
Stay on track with our financial goals.
Exactly. And, as we wrap up this deep dive,
Yeah.
I'm struck by how much this book emphasizes
Okay.
finding that balance
Balance between
financial security
okay.
and actually living a fulfilling life.
Living a good life, yeah.
It's not about denying yourself
Right.
or living like a hermit.
Yeah. You got to enjoy the journey.
Exactly. It's about making choices
Yeah.
that align with your values and your long-term goals.
Values and goals. I
Right.
like that.
So as you reflect on all these insights from how to think about money,
Yeah.
I encourage you to ask yourself this question.
Okay, hit me with a question.
If money wasn't a primary concern,
Money was no object.
what would your ideal work life look like?
Oh, that's a good question.
It really gets to the heart of what this book is all about.
It's not just about managing money.
Right.
It's about designing a life that brings you joy.
And fulfillment.
Joy and fulfillment. I love that.
So what changes would you make? What
Yeah.
passions would you pursue?
What would you do if money wasn't a factor?
It's something to really think about.
It is, for sure. Well, that's all the time we have for today's deep dive into How to Think About Money by Jonathan Clements.
Great book.
It is such a good book. We've only scratched the surface here.
Barely scratched it.
So we encourage you guys to check out the full book for even more wisdom from Jonathan Clements.
Definitely.
And as always, thanks for joining us on this journey of financial discovery.
Always a pleasure.
We'll see you next time for another deep dive.